Hey guys, what's up? I'm Erin and welcome back to the channel. What if the stock market took a 30% hit the day after you retired? Or what if groceries and gas doubled in price over the next decade? Or what if you lived 13 years longer than anticipated in retirement and outlived your money? These aren't doomsday hypotheticals. They're real challenges retirees face every single day. That's why the smartest plans don't just look at averages, they stress test. Best case, base case, and worst case. And today I'm going to show you exactly how to build your own scenarios so you can test your own retirement to see how it holds up no matter what life throws at you. Let's dive in. Let's make this real with an example couple. Meet Mark and Susan. They're both 65 and stepping into retirement. Between the two of them, they've built an $800,000 investment portfolio, half in a traditional IRA and half in a Roth IRA. This balance will help to give them some tax flexibility in retirement. On top of that, they'll have Social Security. Mark's benefit is $3,000 a month. Susan's is $1,500 a month. Together, that's $4,500 a month coming in every single month for a total of $54,000 a year. Their spending goal is around $90,000 to $95,000 a year. They feel like this will give them some room to travel and really enjoy their retirement without having to cut corners. And just like a lot of retirees, their money is going to be invested in a balanced portfolio, about 60% stocks and 40% bonds. So with that as our starting point, let's stress test Mark and Susan's retirement portfolio against three different scenarios: the best case scenario, the base case scenario, and the worst case scenario, and see how it truly holds up. Let's start out with our base case scenario. This is a reasonable plan. So here's what we're assuming. Inflation runs about 2.5%. The market gives us 7% returns from stocks, 2% return from bonds, so our blended average in the portfolio is about a 5% return. And Mark and Susan live to the age of 90. Nothing extreme, just average conditions. So why did we choose these numbers? Well, honestly, they're pretty grounded in reality. A 2.5% rate of inflation going forward, that's pretty close to historical averages. It's not overly pessimistic, it's not overly optimistic. And when we have a blended portfolio, something a lot of retirees do, having a more conservative 5% rate of return, that's pretty standard based on historical averages. And planning for this couple to live to the age of 90, that's not unheard of or unexpected for many healthy 60-year-olds. So this is really a middle of the road estimate. It's not overly optimistic, it's not overly pessimistic. Now let's remember their situation. They've got about $800,000 invested, some in tax-deferred accounts and some in tax-free accounts. This gives them that tax flexibility in retirement. And they are going to be pulling $54,000 a year in Social Security benefits. So this means they're going to need to draw anywhere from $36,000 to $41,000 a year from their portfolio in order to hit their target spending of $90,000 to $95,000 a year. So how does this play out? Well, in this base case, the portfolio more than holds up. If they withdraw on the lower end, that $36,000 a year, their $800,000 actually grows to over $1 million by the time they hit the age of 90. Even if they take out the higher of the two, $41,000 a year, they still finish with around $900,000 in investments. The reason their portfolio grows rather than shrinks is their withdrawals are smaller than what the portfolio returns are. If they're only pulling $36,000 or $41,000 a year and they have $800,000 invested, they get to make their withdrawal, they get to spend, and whatever is remaining stays invested and still capture those market returns. So in other words, under normal historical conditions, this base case, their plan is very sustainable. They get to meet their spending needs and their portfolio continues to grow over time. Now let's do a best case scenario, the rosy outlook. Here's what we'll assume. Inflation averages just 1.5% a year. This is well below the historical average of 3%. Markets perform at the high end of the spectrum, with stocks returning around 8% and bonds about 3%. That works out to roughly a 6% blended return on a 60-40 portfolio. Social Security keeps pace with inflation every single year, so the benefits hold their purchasing power. And Mark and Susan only plan for a 20-year retirement, living from 65 to 85. Now remember their situation. We have a guaranteed $54,000 in Social Security benefits, but our target spending is $90,000 to $95,000. So we still need to pull $36,000 to $41,000 from our investments to meet this need. So how does this plan play out under these assumptions? If they withdraw on the higher end, about $41,000 a year, by the age of 85, their portfolio would grow to roughly $1.23 million. And if they live a little longer, out to the age of 90, they'd still finish with around $1.6 million. But what if they stuck with that lower withdrawal, about $36,000 a year? Well, their portfolio is even stronger. By age 85, their balance grows to about $1.36 million. And by 90, if they live to 90, it climbs all the way up to roughly $1.8 million. Either way, they started with a portfolio of $800,000 and they end with a portfolio that is double that or more. And again, this is because what they're taking out is less than what the portfolio is returning. Compounding is growing this portfolio at a greater rate. And remember, this is our best case scenario. We have really low inflation. We have a strong market performance. We have stable Social Security that keeps pace with inflation. And we have a shorter life expectancy. All of these combine to give us great financial tailwind. And of course, there's the possibility that things could turn out even better if the market performs even better. But this does give an idea of what a rosy outlook might look like. In other words, in this rosy situation, not only do Mark and Susan meet their retirement goals, but they continue to watch their portfolio grow and almost double in size or exceed double in size, and it gives them a really good cushion. And let's do the final one, an absolute worst case scenario. Here's what we're assuming, a sequence of returns shock, the market dropping 20% within the first 2 years of retirement. After that, returns stabilize, but they're still weak. About 4.5% on stocks and 2% on bonds, which blends out to just 3.5% per year, and one spouse living to 100, so now we're testing across 35 years. So how does this play out? Within those first 2 years, we have that negative 20% decline in the market. Mark and Susan started with an $800,000 portfolio, and within 2 years' time, it's just over $450,000. Meanwhile, they still need to make their withdrawals from their portfolio, and ultimately, they're taking bigger and bigger bites out of a smaller and smaller portfolio. Even once the market stabilizes, their portfolio never truly stabilizes. We only have modest returns of about 3.5% per year. By the age of 90, their portfolio is only worth about $150,000. Before the age of 100, that money is completely gone. And if they draw more aggressively, closer to the $41,000 a year, the portfolio doesn't even make it that far. By the age of 90, it's down to just $55,000, and by age 92, completely depleted. This happens when there's a really poor market performance right at the start of retirement, and you have to keep drawing from your portfolio. This can cause permanent damage. This is what's called sequence of returns risk. This is why retirees need to test their plans not just against averages, but also worst case scenarios. But what if we were to make the situation even worse than that? On top of weak markets, imagine inflation runs at 5% a year for the first decade, then stabilizes. That means their withdrawals will have to increase at a higher rate to keep pace with inflation. Then in year 11, a 20% cut to Social Security, and it drops their benefits from $54,000 a year down to $43,200 a year. That's a $10,800 gap that they'll need to find a way to cover. Really, they have two choices at this point. They can accept a lifestyle cut, and rather than spending $90,000 to $95,000 a year, their ballpark spending would be closer to $80,000 a year. Or they can draw more from their portfolio, but now they risk depletion of their portfolio more quickly. So here we've really stacked the deck against Mark and Susan. We've given them every single worst case scenario. Early market losses, high inflation, a Social Security cut, low long-term returns, and a longer lifespan all hitting at once. And if you pile all of these together, Mark and Susan's portfolio doesn't even make it to the age of 90 for the both of them. Instead, it runs out by the time they're in their late 80s, around 87 or 88. Yes, this is an absolute nightmare scenario, but it also highlights why it's so important to stress test your portfolio against the very worst case scenario. Even with all of these worst case scenarios, there are ways to tweak the plan and change the outcome. For example, if Mark and Susan had built up a 5-year cash buffer and were instead drawing on the lower end of their portfolio, $36,000 a year from their cash buffer rather than from their portfolio itself when the market was down, and they gave that portfolio a little bit of time to recover, this does change their outcome. Instead of depleting their portfolio in their 80s, their portfolio would fully carry them all the way to the age of 91. That would really show the power of a cash buffer. Also, this modeling doesn't factor in human behavior. It's very unlikely that Mark and Susan would just sit back and watch their portfolio dwindle down to nothing. They would change their behavior. They may choose to take on some part-time work for some additional income. Maybe they choose to draw less from their portfolio. Maybe they choose to cut back their spending in other areas. When we look at models like this, they don't factor in the element of human choice and the fact that humans respond when they see changes in their environment. But what the numbers do tell us is this: if the absolute worst case hits, and they remained completely inflexible, their path would lead to portfolio depletion. At that point, they would be forced to make drastic cuts. Their only source of income at that point would be Social Security, and it would be reduced. This would not be the ideal lifestyle. A much better plan is to build in flexibility and a cushion and safety. So what is the takeaway from all of this? Retirement isn't just a single number. It is a set of possible scenarios, all with a different range of outcomes. The base case keeps you realistic. It's what happens if things go as expected based on historical data. The best case shows you the upside, what's possible if the markets cooperate and inflation stays low. And the worst case prevents blind spots. It shows where your plan could break if everything stacks against you. Now, are any of these 3 plans perfect? No, but they allow you to test your plan, to remain flexible and build in buffers where you see that there might be weak spots with your portfolio. It's very unlikely that the future will play out like past averages, but retirement planning isn't about predicting the future. It's creating a plan that allows you to prepare for it, and building a buffer into your plan allows you to go into retirement with confidence. So what do you think? Have you tested your retirement plan against the worst case, the base case, and the best case? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. We're good. I gotta go do things. The video I published today is basically how your portfolio can continue growing, and it shows me what type of performer it is. So it says it's number 1 of the past 10 videos I've released. In 3 hours, it's gotten over 15,000 views. That's wild. Also, today was the day that the Money Guys and I released a video. We did it on their channel, a reaction video. I'm just kind of seeing like what that looks like by looking in the studio. You can kind of see, I'll give you a little behind the scenes, what a graph looks like. So in the past rolling 48 hours, this channel has received about 254,000 views. That's kind of wild. Not kind of, I used to get like 4 views a day. That is completely wild and something that I still struggle to digest today. And I think the dogs are done barking, but I spend a lot of time just looking in the studio of YouTube and at the analytics and trying to make these videos better. So if you are not subscribed yet, please do. It really does help the channel. So if you keep coming back for these videos, please subscribe and know that I do look for it on here.